And welcome back to the FRRTP revision compilation revision videos. Yeah, so today we are going to start with in this 16, which is nothing but the property, plant, and equipment, one of the favorite standards of almost everyone, right? Heaven Limited has purchased a machinery on April 20x1 for rupees 30 lakhs, which is reflected in the books of accounts. The return on value of 70 lakh 50,000 on 1 2016. The company has estimated upward revaluation of rupees of 10% and the arrive at the fair value of the asset. Avail the option given by in the case of transferring some of the surplus of the asset is used by the enterprise. April 20, I mean 8. The machinery was revalued downward by 15%, and the company also re-estimated the machinery's remaining useful life to be 8 years. It was sold for 9,35,000. The company charged depreciation on cycling method. Okay, useful life. I have to prepare machinery account. No, it seems simple. Okay, no, it seems simple. I will go only with the working notes. We'll go only with the working notes. Okay, the account you can prepare, right? So the first working note will be just give me a minute. Calculation of useful life of the machinery on 1420x1. See, I have depreciation charge for 5 years, 12,50,000, and per straight line method is 2,50,000, and remaining useful life is 17,50,000 divided by 2,50,000, which is nothing but 7 years total. So total useful life is 12 years. Understood? Yes or no? No. Okay, same. Let me repeat it again. Depreciation charge is 30 lakhs minus already accumulated depreciation, which is reflected in the book around value of 17 lakh 50,000. So the accumulated depreciation would have been 12 lakh 50,000. I have used it for 5 years. So the per year straight line method. That's why per year it will be 2 lakh 50,000. Okay. So I have the remaining. Carrying amount of 17 lakh 50,000, and per year it will be 2 lakh 50,000 depreciation. So remaining useful life will be 7 years. Already 5 years over. Now it is 7 years. So total useful life is 12 years. Okay. Clear. Let's move on. Yes. SRS. Okay. Depreciation after upward revaluation as on 31/3/20 20x6. Okay, let's make it like that. Okay, book value as on 1/4/16 is 17 lakh 50,000. Okay, 10% upward revaluation, 10% apply on this 1 lakh 75,000. So revalued amount will be 95,000. Why did you find the 7 years? Now we have to divide it by 7 years. Now we have to divide by 7 years. So revised depreciation would be 5,000. Then depreciation after downward revaluation as on 31/3/20 20x8. Okay, now here it is 2 years from now. Okay, so it have been 17 lakh, sorry, just give me a minute. 19 lakh 25,000 minus 2 lakh 75,000 minus 2 lakh 75,000, it will be 13 lakh 75,000. 2 years depreciation have been provided. Now 15% downward revaluation. 15% downward revaluation is nothing but 13 lakh 75,000 into 15 percentage. So 6,250. So revalued amount will be 1168,750. 7 years already was there. Now 2 years over. You have make it 5. Now the revised useful life mentioned the question is 8 years. So I have to divide it by 8. Divided by 8. So it will be 11,68,750 divided by 8. So it is 146,094. 146,094. You can round off decimal or you can carry 2 or 4 decimal points. Make it, see, whenever you're writing an exam, it is better to write it as 4 decimal points. 4 decimal points. Even if you're writing as 2 decimal point, follow same entire answer sheet. Okay, don't write somewhere in 3 decimal points, somewhere 2 decimal, somewhere 1 decimal, somewhere 4 decimal. No. If you're using some decimal, use the same for everything. Okay, then transferred from the revaluation reserve. Okay, revaluation reserve as on 1/4 20x6, 1,75,000. Remaining useful life 7 years. So per year I have to transfer 1,75,000 divided by 7. It is 25,000. This is 25,000. Amount that have been transferred would be 50,000, right? 25,000 into 2. So balance would be 1,25,000. Now the downward revaluation amount is 206,250, and to the extent I have revaluation surplus, the first it will be adjusted against the revaluation surplus before I charge it to profit and loss account, right? So first I'm going to transfer adjust against the revaluation surplus of 1,25,000, and the balance of 81,250 will be transferred to profit and loss account. This is where the students make the mistake. This is where the students make the mistake. They forget that it has been revalued before 2 years. Upward devaluation that was done 2 years before, and they charge, what they do is generally 206,250 minus 1,75,000, and they put the answer as 31,250 as amount to be charged to profit and loss account, which is wrong. Which is wrong. Okay. Now, at least gain a friend who say, okay, this you're doing this wrongly. Okay, because that is very much important in CA. Okay, not every time everyone can be right. Not every time everyone can be right. I can also do some mistakes. Okay, it's not that I'm doing it very properly. No, I'm not saying that. Okay, no. Let's move on. Next question. Company A incurred 20,000 as a cost of restoring the site on which the item of PPS was located. This item was used for manufacturing of goods, and the requirement for restoring will arise due to manufacturing of the goods. What will be the treatment of 20,000 in the books of company A? Analyze on the basis of the provision of the relevant NDAs. So what's happening is I am going 20,000 is the cost of restoration of the site, and as I'm going to manufacture some goods, this site has to be restored. Okay, I am live with NDAs 16, so I'm going to tell it here, and also about the provisions contingent liability contingent asset, that is NDAs 37. NDAS 16 clarifies that decommissioning costs that meets the recognition criteria under NDAS 37 for a provision are added to the cost of an item of property, plant, and equipment if such costs are not incurred through the assets used to produce inventories. Paragraph 18 fills the gap by clarifying where such costs are incurred through assets used of producing the inventories. They are added to the cost of inventory. Since here it is first, basic understanding is, so there's a restoration of site, it is in the year 16. But the question gives a keyword manufacturing of goods. So that is the tricky point here. Okay, I went with your flow. Okay, now I'm pointing you that that was wrong and telling this how you have to understand it. Where the obligation to restore arises due to the asset used to produce inventory, but not to the asset installation, construction, or acquisition. The cost are added to the inventory based on the provisions and discussion. Cost of restoring 20,000 incurred as a consequence of having an item to produce inventory should be added to the cost of inventory. Now that I've added, so it will be cost plus this decommissioning cost will be higher. Now I have to compare it to the NRV, and I have to measure it finally at the lower of cost or NRV. So let's repeat the points once again, right? SOS. Yeah. So generally what happens is decommissioning cost with respect to a land is coming with line with NDAS 16, read with NDAS 37. But there is an exception. If the recommissioning cost is involving the use of a land or a property, plant, and equipment which is used in the production of inventories, then such decommissioning cost will be added to the cost of producing the inventory. Here, this decommissioning cost is incurred only because the goods was manufactured. That's why I'm going to add it with the cost of inventories. Okay, cost of inventories rather than adding with the cost of property, plant, and equipment. Then let's move on. In this 16 alone, just keep it on hold. I'm planning to do an entire video which covers almost the RTP, MTP sums, and all the provisions before this month end. Okay, before March end, you will get that video. Now, let's move on. Okay. Yeah. A company. Okay, this again a lease, right? Yeah. So let's keep this on hold. Index 23 borrowing cost. Index 23 borrowing cost. This qualifying asset you can do it, right? Which is towards modernization, that will be a qualifying asset. Advance supplier for additional assets, that is again PPE, that's a qualifying asset. Working capital is not a qualifying asset, that will be charged to profit and loss account. Simple, right? Qualifying asset is an asset that takes a substantial period of time before it is completed and before it's ready for use, right? Then X Limited commenced the construction of a plant qualifying asset on 1st September 20X1. Estimated to cost of 10 crores. For this purpose, it has not raised any specific borrowing. It intends to use a general borrowings. Average weighted average cost is 11%. Total borrowing cost incurred is 0.5 crores. Other relevant details have been given, like cost of construction accrued, cash outflows. Cost of construction accrued and cash outflows are being given. Based on the above information, discuss the treatment of borrowing costs as per the cash flow basis and accrual basis, and also suggest the appropriate amount of interest that should be capitalized to the cost of plant in the financial statement. Now let's move on. Paragraph 14. Okay. Paragraph 14. Entity states that to the extent the entity borrows funds generally and uses them for the purpose of obtaining a qualifying asset, the entity shall determine the amount of borrowing cost eligible for capitalization by applying the capitalization rate to the expenditures on the asset. The capitalization rate shall be the weighted average rate of the borrowing cost applicable to the all borrowings of the entities that are outstanding during the period. However, an entity shall exclude from this calculation of borrowing cost applicable to borrowings made specifically for this purpose of qualifying asset until substantially all the activities necessary to prepare the asset for its intended use or sale is complete. The amount of borrowing cost the entity capitalizes during the period shall not exceed the amount of borrowing cost it is incurring during the particular period. In this context, whether such expenditure should be based on cost accrued or actual cost outflow. To contrast these two alternatives presented below is the computation of the borrowing cost under both of these alternatives. Okay, if I go based on cost of construction accrued, okay, it's 9.5 lakhs. I'm going to put it on the September, means September, October, November, December, Jan, Feb, and March, right? September, October, November, December, Jan, Feb, and March, 7 months. So I'm putting like this, okay? And like it is 2.74. While if I take it as cash flows and assuming it to be the start of the month, assuming this to be start of the month, if it's the end of the month, I will take 6 by 12. This is in the beginning of the month, so it's 7 by 12. I'm going to take it as 4.0. That is the average capital expenditure. Average capital expenditure. So now, if the average capital expenditure on the basis of cost accrued is taken, the borrowing cost eligible would be 2.74 crore. That is the, this is the weighted average capital expenditure, right? So 2.74 crore into 11%, whereas average capital expenditure on basis of cash flows taken, it is 4.02 crore into 0.44 crore. Thus, there is a wide variance in the amount of borrowing cost to be capitalized. This divergence is often experienced during the implementation of large projects. Okay. As per 18 of India's 23, expenditure on qualifying asset includes only those expenditure which have resulted in payments of cash, transfer of other assets, or the assumption of interest-bearing liabilities. See, expenditure for the purpose of qualifying asset includes, this is a very important point, with a very important point to be written in an exam. Okay, if this question is asked or similar question is asked, this is an important point. Expenditure on a qualifying asset include only those expenditure that has resulted in the payment of cash, transfer of other assets, or the assumption of interest-bearing liabilities. Okay, are reduced by any progress payments received, grants received. Okay, that has to be reduced. Average carrying amount of the asset, including the borrowing cost previously capitalized, normally reasonable approximation of the expenditure to which the capitalization rate is applied. Where cash has been paid but the corresponding cost has not yet accrued, it becomes a interest becomes payable on payment of cash. Interest becomes payable on payment of cash. Therefore, please give me the amounts of paid should be considered for determining the interest eligible for capitalization. Interest should be computed on the basis of cash flow. So some 4 crores odd into 11%. Okay, then therefore the amount interest eligible for capitalization is 0.44 crore. Another important factor is that this interest should not exceed the actual interest accrued, interest for that particular period. Right. The amount of borrowing cost that entity capitalizes shall not exceed the amount of actual borrowing cost incurred during the period. The amount of the borrowing cost eligible to be capitalized should not exceed the total borrowing cost incurred during the period. That is 0.5 crore. So this is less than this. We will capitalize this amount and take the 0.06 crore to the profit and loss account. Clear? Let's move on. Company is constructing a huge building project consisting of 4 phases. It is expected to the full building will be constructed over several years, but the phase 1 and phase 2 of the building will be operational as soon as they are completed. Following the detail of the work done on different phases of the building during the current year. Phase 1 cash building purchase total expenditure of all phases loan taken. Okay, phase 1, phase 2, phase 3, and phase 4. After taking a substantial period of construction at the mid of the year, phase 1 and phase 2 have become operational. Find the total amount to be capitalized. See, at the mid of the current year. Now, answer number 3. Let's move on. Interest expense on loan. What is the interest expense on loan? It is 2 crores loan. 2 crores loan and right, 2 crores loan taken at the rate of 15% at the beginning of year. So 12 months I have to calculate the interest. Okay, 30 lakhs. Total cost of phase 1 and phase 2 is 34 lakhs and 64 lakhs, 94 lakhs. Phase 3 and phase 4, 55 plus 68. Okay, then total cost of all four is 221. Total loan is this much. And interest on loan for phase 1 and phase 2 will be 30 lakhs, 30 lakhs, 30 lakhs divided by 21 lakhs into 98 lakhs. It's nothing but 13 lakh 30,316. This is typo error. Okay, please ignore. Okay, and then the remaining would be a portion for the what? I'm sorry. For the phase 3 and phase 4. Okay, accounting treatment. Since phase 1 and phase 2 have been operational in the mid of the year, half of the interest amount will be capitalized and half should be charged to profit and loss account. See, we have 13 lakh 30,000, 30,317 divided by 2, 6 lakh 60,000. One part will be transferred profit and loss account, the other part will be capitalized. The entire will be capitalized. Okay, no part will be charged to expenses. Now, Hari's construction company, this is the same question. Sorry. Okay, then in the intangible asset. X Limited purchased a franchisee from a restaurant chain at a cost of 1 crore under a contract for 10 years. Can a franchisee right be recognized as an intangible asset? Okay, what is the definition of intangible asset? Close your eyes, recollect it. Yes, I hope everyone done it. If not, please pause this video, do it, and then come back. Okay. Intangible assets defines, in this 38 defines intangible asset as under an asset is a resource controlled by an entity as a result of past event and from which future economic benefit is expected to flow to the entity. An intangible asset is an identifiable non-monetary asset without physical substance. Identifiable non-monetary asset without a physical substance. In accordance with the above, for considering an asset as an intangible asset, an entity must be able to demonstrate that it satisfies the criteria of identifiability, control over the resource, and existence of future economic benefit. In the given case, franchisee right means the definition of identifiability criterion as it is arising from a contract. Future economic benefit is there, and then I have a control over them. It means the definition of intangible asset. The same can be recognized if the following criteria is fulfilled. Only if and only if it is probable the future economic benefits that are attributable to the asset will flow to the entity and cost can be measured reliability. In this case, identifiability criteria is fulfilled. Future economic benefits also there. Cost can also be measured. Therefore, it should recognize the intangible asset. It should recognize the intangible asset. So let's move on. An entity is an identified intangible asset in the form of product protected by a patented technology, which is expected to be source of the net cash flow for at least 15 years. It has been recognized in the books of account initial date at 12 lakhs. The entity has a commitment from a third party to purchase the patent at the end of 5 years for 60% of the fair value of the patent as the date it was acquired, and considering it intends to sell the patent in 5 years. The company is amortizing the asset in 15 years, considering its residual value to be 0. Annual amortization is charged to profit and loss account at the rate of 80,000. State of the accounting treatment done by the company is in accordance with Ind AS 38. If not considered the annual amortization of the intangible asset and also the amount at which it will be reflected in the balance sheet. See, useful life is entity specific. Useful life is entity specific. Assume. Okay, before we move on, let's take a look something. How far it's related to question? Let's see it out. Okay. I am buying a TV. Okay. I am buying a TV. I'm an organization. Assume I'm buying some TV. Okay. I am thinking to use this TV only for next 2 years. Only for next 2 years. But generally, people use that TV for next 5 years. Okay. Then what is the useful life? You will say it is 2 years. Right. Similarly, here I'm going to use it only for 5 years. Even though it is valued, it is available till 15 years, I'm going to use it only for 5 years. That will be known as useful life. So let's check how well it is related to this question. For determination of amortization of intangible asset, which has a finite useful life, two elements has to be determined: useful life and residual value. Useful life is defined as the period over which the asset is expected to be available for use by the entity, or the number of production of similar units expected to be obtained. In this case, entity expects the asset will be available for use only for 5 years. That will be known as useful life. For the residual value, this India states that Residual value of an intangible asset with a finite useful life shall be assumed to be zero unless the is a commitment by a third party to purchase the asset at the end of the useful life. This is an active market. Residual value can be determined and probable that the market will exist. Depreciable amount of the asset with the finite useful life is determined after deducting the residual value. An estimate of the asset's residual value is based on the amount recoverable from disposing using the prices prevailing at the date of the estimate. Okay, so here, on application of the above paragraphs, the depreciable amount of the patent will be determined after deducting the 60% of the fair value. Accordingly, 5 years will be the useful life. Residual value equal to 60% of the fair value. So what I'm going to do is cost is 12 lakhs. Cost is 12 lakhs. And 60%, assume the cost is the fair value. Okay, so 12 lakhs into 60 percentage. It is 7,20,000. That will be the residual value. So balance will be 12 lakhs into 40 percentage, right? Into 40 percentage, which is nothing but 4,80,000. Useful life is 5 years. And I'm going to put it as depreciation as 96,000. Okay. Now let's move on. Yeah. In the S40, investment property. So we'll do this or try, I'll check with the next channel as only one question, then we'll do it, or else we'll complete with this. Okay. An entity owns a two-story building. Floor 1 is rented out, independent parties under operating leases. Floor 2 is occupied by the entity's administration and maintenance staff. The entity can measure reliably the fair value of each floor of the building without undue cost or effort. Okay. How much will be the same? Investment property is a property. Investment property is a property held to earn rentals or for capital appreciation or both. See, it's only, when you think about investment property, the only thing which will come to your mind is land and building, land and or building, nothing else will come. Okay, land and or building, okay, clear. Use the production or supply of goods or for administrative purposes rather than okay, sale in the ordinary course of business. Then if it is used in production or sale in the ordinary course of business, then it will be coming under property, plant, and equipment or inventory. Applying the provision, floor 1 should be classified as investment property because it's held to earn rentals. NDS 40 is applicable in this case. And investment property should be measured initially at the cost. After initial recognition, the entity shall measure all the investment properties in accordance with NDS section requirements for cost model. However, the entities are required to measure the fair value of the investment property for disclosure purposes. See, with respect to investment property, I have to measure and recognize everything in cost. Only it should be followed. But for disclosure purpose, I have to mention the fair value. Floor 2 of the building is used by the administrative staff, and that's why it will be classified under property, plant, and equipment. Then, after recognition, the entity shall choose either to use the cost model or the evaluation model and shall apply the policy consistently to entire class of property, plant, and equipment. Okay? Then. Okay, we have only 2 questions. We'll complete this. Okay? And then we'll wind up for the day. Okay? On February 1, 2820X1, the entity X is committed to the following plans: to sell a property after the completion of certain renovation to increase its value prior to selling it. The renovations are expected to be completed within a short span of time, that is 2 months. To sell a commercial building to a buyer after the occupant vacates the building, the time required for vacating the building is usual and customary for sale. Usual and customary is a highly important point. Usual and customary. The entity considers the sale to be highly probable. Can the above mentioned property be on commercial building can be classified as non-current asset held for sale as the reporting date? In the S105, that is non-current asset held for sale and discontinued operation, provides a guidance on the classification of non-current asset held for sale, which states that the asset or the disposal group must be available for immediate sale, in its present condition, subject to only the terms that are usual and customary for sales, and its sale must be highly probable. Okay, in the first case, I'm going to sell it after the renovation. Okay, that's so, which means it's not currently ready for sale. All the renovations are expected to be completed within 2 months. Okay, but because the reporting date comes in between, the same cannot be classified as held for sale. In case of the B, it is only that it is usual and customary, and that's why I'm going to make it ready for immediate sale, and it will be shown as held for sale as the reporting date. Okay, then let's move on. Second one is very simple. I think that can be managed, and third one will do it. Company A has a financial year ending 31st March 20x0 on 1st June 20x0. Company classified division B as held for sale in accordance with 105. How the property, plant, and equipment for the company as a proper cost model shall be measured immediately before the classification of held for sale as on 1st June 20x0. Paragraph 18 provision immediately before initial classification of the asset as held for sale. Carrying amount of the asset shall be measured in accordance with applicable in the years. In the instant case, company should measure the property, plant, and equipment in accordance with in the year 16. In the year 16, and the depreciation should be provided till 31st March 20, 31st May 20x0. So with this, we complete this video. We'll catch up the next video. Stay tuned and to subscribe here for the first time here, and have a great day. Thank you.